There's a pattern hidden in the numbers that has predicted every major economic collapse for nearly a century. It whispered warnings before the Great Depression crushed millions of lives. It screamed danger 2 years before the 2008 financial crisis wiped out trillions in wealth. And right now, today, it's flashing red again. The yield curve doesn't lie. It doesn't care about optimism or government promises or expert predictions. It simply tells the truth about what's coming. And if history is any guide, what's coming is devastating. Most people have never heard of the yield curve, but it's the financial world's most ruthless fortune teller. Picture it as a simple line on a chart showing the difference between short-term and long-term interest rates. When everything is normal, long-term rates sit higher than short-term rates. That makes sense. You demand more money to lend cash for 30 years than for 3 months. But when that line flips, when short rates climb above long rates, something sinister happens. The curve inverts, and when it inverts, recession follows. Not sometimes, not usually, always. Since 1960, this pattern has preceded every single recession in the United States. Every crash, every collapse, every moment when millions of people lost their jobs and their savings. There has been exactly one false alarm in over 60 years. One. That's a success rate that would make any fortune teller jealous. But this isn't magic. This is mathematics. And the mathematics are terrifying. Here's what makes this even more chilling. The yield curve doesn't just predict recessions. It predicts when they'll hit. The rule is brutal in its simplicity. When the curve inverts, you have about 12 to 18 months before the economy collapses. 12 to 18 months to prepare for what's coming. 12 to 18 months that most people waste believing everything will be fine. Let's go back to 1929. America was flying high. The stock market was soaring. Unemployment was low. Everyone believed the good times would never end. But in 1928, something quiet happened in the bond markets. The yield curve inverted. Most people didn't notice. Most people didn't care. They were too busy getting rich off rising stock prices. But the curve was sending a message. It was screaming that the party was about to end. And here's the truly brutal part. Even after the yield curve inverted in 1928, the stock market kept climbing. It didn't just climb, it exploded upward. Between 1928 and its peak in 1929, the market nearly doubled. People who had heard whispers about some inverted curve laughed it off. Look at the stock prices, they said. Look at the prosperity. Everything is fine, until it wasn't. When the crash came in October 1929, it was merciless. Black Monday saw the Dow plunge 13% in a single day. Black Tuesday was worse, with another 12% vanishing into thin air. By mid-November, half the market's value had evaporated. The slide continued for years. By 1932, the Dow had lost 89% of its value. 89%. Fortunes built over decades disappeared in months. But the yield curve had warned them. It had given them over a year to prepare. Most ignored the warning. They paid the price with everything they had. The Federal Reserve played a starring role in this disaster. Throughout the late 1920s, they watched the stock market bubble grow larger and more dangerous. They saw speculation running wild, so they did what central banks do. They raised interest rates to cool things down. The federal funds rate climbed higher and higher, pushing short-term rates above long-term rates. The curve inverted. The warning was sent. But raising rates didn't just hurt American markets. Because the world was still on the gold standard, other central banks were forced to raise their rates too. Tight money policies spread across the globe like a virus. One by one, economies began to crack. When the final collapse came, it wasn't just American, it was global. The yield curve hadn't just predicted an American recession, it had predicted a worldwide catastrophe. Fast forward to 2005. Most Americans were living in their own version of the roaring 20s. Housing prices were climbing month after month. Everyone was getting rich off real estate. The experts said housing prices never fall nationwide. People borrowed against their homes to buy bigger homes. The party felt like it would never end. But in the bond markets, something familiar was happening. The Federal Reserve had been raising rates aggressively since 2004. They were worried about bubbles forming in housing and other assets. Short-term rates climbed higher and higher. In December 2005, the yield curve inverted. The warning was sent again. Just like in 1929, most people ignored it. Housing prices kept climbing through 2006. The stock market kept rising. Everyone was making money. The experts explained away the yield curve. This time is different, they said. The old rules don't apply anymore. Housing is a safe investment. Nothing bad can happen. The yield curve stayed inverted through 2006 and into 2007. For over a year, it kept screaming its warning. Banks kept lending. People kept borrowing. The housing bubble kept inflating. Then in 2007, the first cracks appeared. Mortgage delinquencies started rising. A few small lenders went bankrupt, but the experts said it was contained. Nothing to worry about. By 2008, containment was a cruel joke. Bear Stearns collapsed in March. Lehman Brothers followed in September. The entire financial system teetered on the edge of complete collapse. Unemployment soared from 5% to 10%. The stock market lost half its value. Housing prices crashed nationwide, destroying trillions in wealth. The Great Recession had begun, right on schedule. Once again, the yield curve had been right. It had given nearly 3 years of warning. Most people had ignored it. They lost their homes, their jobs, their retirement savings. The few who listened and prepared survived. The many who didn't paid the price. Now let's talk about today. In July 2022, the yield curve inverted again. Not just inverted. It inverted deeper and stayed inverted longer than any time since 1929. We're talking about over 700 days of inversion, 700 days of the bond market screaming that recession is coming. The Federal Reserve triggered this inversion the same way they always do. Inflation was running hot in 2021 and 2022, hitting levels not seen in 40 years. So the Fed did what they always do. They raised rates aggressively. The federal funds rate shot up from near 0 to over 5% in less than 2 years. Short-term rates soared above long-term rates. The curve inverted dramatically, and just like 1929 and 2005, most people are ignoring the warning. The stock market has been hitting record highs, unemployment remains low, consumer spending stays strong, the experts are back with their familiar refrain, this time is different. The old rules don't apply, the economy is resilient, nothing bad can happen. But the yield curve doesn't care about expert opinions. It doesn't care about stock market records or unemployment statistics. It simply reflects the cold mathematics of interest rates and investor expectations. And right now, those mathematics are telling the same story they told in 1929 and 2008. Here's what makes this situation even more dangerous. This isn't just any yield curve inversion. This is the longest and deepest inversion since the Great Depression. Historically, longer inversions lead to bigger crashes. The bond market isn't just whispering a warning, it's shouting from the rooftops. The mechanism behind this warning is brutally simple. When investors look at the future, they see trouble coming. They're willing to accept lower returns on long-term bonds because they believe short-term rates will have to fall dramatically when the recession hits. They're betting that the Federal Reserve will be forced to cut rates to zero again, just like they did in 2008 and 2020. The yield curve inversion is their way of positioning for that inevitable collapse. But there's something different about this cycle that makes it even more treacherous. The government has been spending money like a drunken sailor. Federal deficits are running at over 6% of GDP during what's supposed to be good economic times. That's unprecedented. Historically, governments only spend like this during wars or recessions, but we're doing it during what everyone insists is a strong economy. This massive government spending is masking the underlying weakness that the yield curve is detecting. It's like giving a heart attack patient adrenaline shots. For a while, but the fundamental they might look healthy problem is still there, getting worse. The Congressional Budget Office projects these deficits will keep growing, reaching over 6% of GDP through 2025. That's not sustainable. And when the crash comes, the government won't have the fiscal firepower to fight it like they did in 2008. The housing market tells another piece of this story. Unlike 2008, housing prices haven't collapsed yet, but they're starting to crack. Mortgage rates have doubled from their pandemic lows. Home sales are falling. Construction is slowing. The yield curve is warning that housing will be the next domino to fall, just like it was in 2008. And when housing goes, everything else follows. Corporate debt is another time bomb waiting to explode. Companies borrowed trillions during the years of zero interest rates. They issued bonds at 2 and 3%, thinking cheap money would last forever. Now those companies are facing a brutal reality. When their debt comes due for refinancing, they'll have to pay 5, 6, even 7%. Many won't survive that transition. Corporate bankruptcies are already starting to climb. The banking system is showing stress fractures too. Regional banks are sitting on hundreds of billions in underwater bonds, purchased when rates were near zero. As depositors demand higher returns, these banks are getting squeezed. We saw the first cracks in 2023 when Silicon Valley Bank and Credit Suisse collapsed almost overnight. The yield curve is warning that more bank failures are coming. But here's what makes this situation truly terrifying. The people in charge are making the same mistakes they always make. The Federal Reserve is already talking about cutting rates, even though inflation hasn't been fully defeated. They're worried about the very recession that their own policies created. It's like an arsonist trying to put out the fire they started with more gasoline. Politicians are promising that everything will be fine. They're pointing to stock market records and low unemployment as proof that the economy is strong. But these are the same lies told in 1929 and 2007. The surface looks calm while the foundation crumbles underneath. The international situation makes everything worse. Global debt has exploded to record levels. China's economy is teetering on the edge of deflation. Europe is struggling with energy costs and demographic collapse. When the American recession hits, it won't stay contained. Just like 1929, it will spread across the globe, toppling governments and destroying currencies. Central banks around the world have exhausted their ammunition. Interest rates are already near historic lows in most countries. They've printed trillions in new money over the past decade. When the next crisis hits, they won't be able to respond like they did in 2008. The tools that saved the system last time are broken. The yield curve is also warning about something even more sinister: currency collapse. When governments can't service their debts and central banks can't print their way out of trouble, confidence in paper money evaporates. We're already seeing early signs of this. Countries are moving away from the dollar in international trade. Gold is hitting record highs. Bitcoin is being adopted by entire nations as legal tender. Smart money is already positioning for what's coming. They're moving out of stocks and bonds and into real assets, land, gold, energy, food production, things that will hold value when paper promises become worthless. They understand that the yield curve isn't just predicting a recession, it's predicting a complete restructuring of the global financial system. The timeline is becoming clear. If history is any guide, we have until late 2025 or early 2026 before the full crisis hits. That gives you maybe 12 to 18 months to prepare. 12 to 18 months to get your financial house in order. 12 to 18 months to position yourself for what could be the biggest economic collapse since the Great Depression. The yield curve has never been wrong about the big picture. It warned about 1929, it warned about 2008, it's warning about 2025. The only question is whether you'll listen this time or whether you'll join the millions who ignored the warning and paid the ultimate price. The mathematics are clear. The pattern is unmistakable. The yield curve is screaming that time is running out. What happens next will determine whether you survive what's coming or become another casualty of economic history. The warning signs are everywhere, if you know where to look. Consumer confidence surveys are starting to crack. The University of Michigan's long-term inflation expectations just hit their highest level since 1995. That's not a coincidence. People sense something is wrong even if they can't articulate it. The Conference Board's expectations index has plunged back to recession levels. These aren't abstract economic indicators. They're measuring the fear creeping into ordinary people's minds. But the most terrifying part isn't what's happening now. It's what comes after the yield curve stops screaming. Because here's the pattern that destroys lives. The yield curve inverts, stays inverted for months or years, then suddenly steepens again. That steepening isn't a sign of recovery. It's the final warning shot before everything collapses. Look at May 1929. The yield curve had been inverted since 1928, warning of trouble ahead. Then suddenly it steepened. Stock market bulls celebrated. Finally, they said the curve was returning to normal. Everything would be fine. 5 months later, Black Tuesday destroyed their world. The steepening wasn't a recovery signal, it was the bond market positioning for the crash it knew was coming. The same pattern played out in 2007. The yield curve had been inverted since late 2005, flashing recession warnings that everyone ignored. Then in mid-2007, it began to steepen. Wall Street cheered. The inversion was over. The recession fears were overblown. 18 months later, Lehman Brothers collapsed and took the global economy with it. This is why timing matters so much. The yield curve doesn't just predict that bad things will happen, it predicts when they'll happen. And right now, we're approaching the most dangerous phase of the cycle. The curve has been inverted for over 2 years. It's starting to show signs of steepening. If history repeats, we're entering the final countdown. The yield curve has spoken. 3 times it has warned, and 3 times those warnings have come true. 1929, 2008, and now 2025. The pattern is unbroken, the mathematics unforgiving. You have been given the same 12 to 18 months that others received and wasted. The question isn't whether the collapse is coming. The question is whether you'll prepare for it or pretend it away like everyone else. History doesn't repeat, but if you ignore its lessons, it will crush you all the same.